opportunity.
It was almost like too big to fail and too small to care.
This is the Van Scroll Podcast.
Welcome back to the podcast. I'm glad you're here. Each week on this show, I try and interview an expert to discover what it is that they know about a subject that we could learn from. And I also try and find out how did they develop the discipline to get where they are at in their career. This week's interview was with a woman named Rita Kuster, who's the Chief Credit Officer of St. Louis Bank, where I am a member of the Board of Directors. But I'd never actually had a chance to sit down with Rita and hear her biography and how that informs decisions she makes at the bank. She'll talk about being a banker's banker and even working for the Federal Reserve, but later in the conversation, when we start talking about things like too big to fail and Wall Street versus Main Street, you can hear how this experience allows her to have a perspective that you don't hear very often. We also get into what goes on behind the scenes. How does a bank make a decision as to whether or not to grant a loan to someone? And she also gets into the conversation around how do you create the tension within a boardroom to get people to have the conversations they need to have and be willing to disagree with one another. This was very interesting and an unusual interview for a banker. I was quite pleased with how it went and learned quite a bit. So I hope you will buckle in and enjoy the conversation with Rita Kuster of St. Louis Bank. Rita Kuster, welcome to the podcast.
Thank you, Vance.
So we have known each other for about a year and a half because you are the Chief Risk Officer, is that right?
Chief Credit Officer.
Chief Credit Officer, but your job is to mitigate risk at a bank.
That's part of it, yes.
Part of it.
Yeah.
So what does it mean to mitigate risk?
I'm primarily on the lending side, but as a bank as a whole, there's all kinds of risk, whether it's compliance risk, credit risk, liquidity risk, reputational risk. I primarily, like I said, are on the credit side of it. And what that means is on the lending side. So what I'm trying to do is make sure we make right loan decisions or good loan decisions to ensure that we basically get our money back and that the borrower gets what they need as far as financing. Because I'm in a community bank, which is smaller, you tend to get involved in different risk. And so while it's not as broad as a total risk officer, there's definitely pieces of it that all of us have to deal with because we're in a bank that small.
So maybe just to put it in the simplest terms possible, there's a person that goes out and finds somebody that wants to borrow money,
Correct.
the loan officer,
Yeah.
and they get excited about the loan and they're pumped up. They found a person that really wants their help, and then they write it up in a package and they bring it to your department and they say, I think we should give this person money. And your job is to say, maybe not.
Sometimes, you don't want to go into it saying, on the credit side, saying, I want to say no, no, no. There are times where maybe you structure it different to get you comfortable, or you get more collateral to get you comfortable. So I don't want to be like a Dr. No. You want to be make the right decisions and see if you can make the deal. But I don't think us making a deal every time helps a borrower. Sometimes no is the best answer for a borrower because they might think, their idea is the best. They might think, this is going to work. And we see things that are like, maybe you don't want to do that. Maybe you want to revisit it at a different time. So, like I said, we try to do it, but we try to make sure it's right for the bank and right for the borrower.
So you have an interesting background because you're not just the no or
Correct.
Finding the right, but you actually started out as a regulator.
I didn't start out as a regulator. I worked at a bank, and it was a specialty bank, and maybe that's where I'm so closely tied to community banking. I started at a bank in Jefferson City, Missouri, that was a banker's bank, and what that meant was we were owned by other banks. It was kind of a co-op, I guess. And collectively, it was all small community banks that worked with this bank to get some of their services. So I worked in Jefferson City for this banker's bank, and at the time there was only like 19 of them in the nation. It was a correspondent bank, and after that, because I had done so much bank work, I actually moved to St. Louis and got a job with the Federal Reserve here and was on the regulatory side. So I was a bank examiner after that.
So does that mean you were the person that showed up in the black SUVs when something had gone horribly wrong?
Fortunately, or maybe unfortunately, there wasn't a lot of problem banks at the time I was a regulator. So I would have been maybe that person, but we didn't have... I wasn't a regulator during the banking crisis when all the banks were closing. I was, it was a smoother time then, but we showed up at banks on a Monday with our audit bags and, took a look at all kinds of stuff. And, normally because we were in smaller banks, we'd be there 1 to 2 weeks and make our assessment of the safety and soundness of the bank and move on. So...
Okay, so let's talk a little bit about this because I had no idea just how regulated banking was, right?
Yeah.
Like when you look from the outside, you look at a bank and you say, there's a group of people that have money, they put it together, and then they make decisions on who are we going to give money out to, and they're going to pay us for the value of borrowing money, and then we make money that way. But the federal government and state government are deeply, deeply involved in banking. And almost to the extent that, to me, I feel like, what are we allowed to do? But when you showed up with your suitcases on Monday morning, what are you looking at for a bank? I mean, like, these are really serious moments for a bank when the examiners show up.
They are, but they shouldn't be. We show up, as a regulator, we'd show up every year and a half. And it was just kind of a check. If a regulator told a banker something that they didn't know, that's when we were concerned, because most of the time they're in the bank every day. They should know, or they know what's happening in their bank and, how their loan portfolio is looking or what their liquidity looks like. And if I was a regulator and I walked into a bank and started seeing some problem loans and I went to the senior lender or whoever we were dealing with, and they were shocked, that's when I got concerned. Because it's like, I shouldn't be telling you this.
What do you mean a problem loan, and why wouldn't these people know about it?
Maybe they're not monitoring it. Maybe they're just, the person keeps making their payment. And we would only look really at commercial loans. We weren't looking at mortgages, those kind of things for the most part. Maybe they were just monitoring it, and the borrower's making their payments. We're good. And that's
what's
that's
wrong
it.
with that?
Well, it's all okay until you get their financial statements, and maybe you look at it and you realize, their revenues are down, their income's down, their cash flow is strained, or maybe, there's something happening with the collateral piece. So there's all kinds of monitoring that has to happen as well once you make that loan, particularly on the commercial side of the business. You can't make it and forget it.
So that's super interesting, right? That it's not just it's not just the loan officer saying, can I get the bank to make this loan? Because then the bank actually has to prove to the Federal Reserve and the state regulators, hey, look at this financial health of this company. They're still doing okay. They could get in trouble if they have too many loans out where the retail sales are going down, or
yeah.
what?
I mean, but it's really not. They're not proving it to the regulators. They're really just running their business, and it's part of their responsibility to their shareholder and to the safety and soundness of that bank. The regulators are just there just to check because it is a highly regulated institution. There's an FDIC insurance sticker that makes them. That gives them some protection, gives their depositors protection. And as a regulator, you're just making sure that they're doing what's right and doing it in a safe and sound manner. I never felt as a regulator that we were there just to just to check up. We weren't running the bank. They were running the bank on a day-to-day basis. We were just there to make sure everything was going okay. And but if you went in and you found a bunch of loans, problem loans, it became real problematic for that institution, because as a regulator, you can do some stuff or, require them to do things differently, because you're there to protect the depositors. You're there to protect the safety and soundness of that institution.
So what are you allowed to do if you're a regulator? So let's keep going with this scenario. Maybe you can imagine a time when you found out that there was, trending down a series of loans. Now, what does Rita say? What do you do?
It really depends on the severity. If you have just a few and you don't see a pattern of they're not paying attention or whatever, you at the end of the exam, you write up an exam report. You actually rate the bank on different components of their balance sheet, and give them suggestions or give them items like, we want you to do this, we want you to do that, and maybe it's improve your loan review, improve your receipt and review of financial statements, those kind of things. And if it's not too bad, you check up with them in a year when you go back, or another regulatory agency goes back. If it's really severe, there are different things that the regulators can do from the standpoint of a written agreement with them. They can put you under what they call a memorandum of understanding, where the board gets involved. So you as a board member, there's a lot of responsibility for making sure that there's processes in place and everything is working like it's supposed to. So what a regulator can do is go to the board and say, okay, board, you need to improve the operation of this bank. So like I said, as a board member, you're definitely have some liability and have some responsibility. And like I said, the regulators, as it would get progressively worse, let's say...
Does it get progressively worse? Like, did you see times when that happened? Or is this all like, in theory, we have the playbook and...
Most of the time you don't. Most of the time they address it and you move on. Other times where, when we went through the banking crisis, there was so many problems, and sometimes there was nothing you could do about it. There was the economy was so rough that you tried and tried, but there were so many things from an economic standpoint that made it difficult, that it was hard for banks to turn around. And
where were you during the banking crisis?
I was at a bank here in St. Louis. It's since been sold, but it was a Pulaski Bank, who had been around for 99 years, and I was on that side fighting the good fight.
So you were like risk, credit, that side of things?
Yeah.
And so at what point were you like, this isn't just a recession, this is bad? I think we all knew it, just from what was happening in the nation as a whole, with different banks and all the pressure that was happening in the economy as far as past dues and foreclosures. And you saw so people could see this coming, like. I mean, maybe not in time to stop it, but you saw that the roller coaster was headed down.
Yeah. I mean, our and we didn't have, luckily, we didn't have the severity of problems that a lot of banks had. But I think every bank had issues to work out during that time period. But what you would typically see is maybe your past dues crept upwards, or maybe as you did renewals on borrowers. We were renewing a loan, and we would get a new appraisal, and suddenly that value from 3 or 4 years ago of, let's say, $500,000, you'd get it appraised, and now it was $300,000. And maybe your loan was for $400,000.
So now they're totally underwater.
Yeah. So then, and that was stuff that, as a banker, you couldn't control what the value of that real estate was, but because of the market and how many problems there were, you just had to deal with it. And, so that's where a lot of the problems came for, kind of working it out was, okay, well, what do you do now? Can you shore that up? Can that borrower pledge additional collateral or pay down the loan? Do they have the liquidity? That kind of stuff. So it was a lot of strategy behind every loan that you got concerns with, and sometimes it was, how do you make this better? How do you get the credit risk to an acceptable level? But I think every bank, had their share of issues during that time. Luckily, we worked through them. We came out of it A-okay. There were a lot of other banks that had the people show up in the black SUVs and shut them down.
And so did you work at Pulaski after you were a regulator?
Uh-huh.
So then were you calling your regulator friends and saying, like, what do you see?
Not on an ongoing basis. I would certainly I'd keep in contact with some of them, but the regulators were calling all the banks. That was
you didn't have to go to them; they came to you.
They definitely came to you, and they were trying to get ahead of it and making sure the banks were on top of things and that kind of stuff. Being a former regulator, I understand kind of what their mission is, and it wasn't to shut down all these banks. It was to make sure that they could make it through this, through the recession and come out the other end. And like I said, we did. Not all of them did. So.
And what happens when a bank got shut down? So let's say the people came in and they said, "Look, you bank, you are underwater yourselves." Yeah. Then what happens?
Most of the time, they have another bank kind of in the wings to take over the deposits and sometimes work through some of the loans for them. There was a lot of unique things that the regulatory agencies did during the recession to help work through all those problem loans. Some of it was, they called it loss share arrangements, where the bank that acquired those assets worked with worked with the FDIC to kind of work through the loans that were on the portfolio. But most of the time, if a regulators come and shut down a bank, that bank is not surprised. I mean, they know there's problems. They know they're, out of capital. So it wasn't like a surprise. And as a banker in St. Louis or in anywhere, you knew what banks were on the bubble.
Oh, you did?
Oh, yeah. I mean, you could tell. There's some ratios that are public ratios that you could still get to this day. There was one ratio called the Texas ratio that became very, very popular, and it was the amount of non-performing loans and or other real estate owned as a percentage of
ORE is everybody.
Yeah, as a percentage of their equity capital. And if they had, if that ratio creeped up to, like, say, over 100, you knew that bank had a lot of problems. And so that got a lot of play, like, what's the bank's Texas ratio? And it was just really a percentage of how much of their capital was in, how many bad loans they had as a percentage of the capital base. And so, it's a ratio that is, you can get on any bank still today. So
just by going and Googling it?
Yeah, you can find it. But it's, that became, you'd see these banks with these high Texas ratios, and you knew they had tremendous problems, that they were likely trying to work through, but it was no secret, I guess. And banking's a small community, so, you ended up kind of knowing what banks were working through problems and stuff like that.
So the people that were in credit positions that had their bank go upside down, their Texas ratio goes sideways, and it's either their bank gets shut down, they move on and they are shamed out of the industry, or they get positions and, hey, that was a really expensive education that you just got?
No, I mean, they move on. The industry is, if they've got some banking experience, there's definitely a room for those types of underwriters. Most of the time, those folks would stay on with the bank that acquired them. They would just ultimately make a decision whether they wanted to be with that institution. But, that underwriting knowledge is pretty marketable for a lot of people. So it wasn't like they were shunned or anything like that for the most part.
And what's the difference between what happened with community banks and what happened with like the giant banks, the Bank of America or Wells Fargo, those kind of things?
So it's unfortunate. I think. So you have these mega banks that they would call too big to fail, because it was a systemic problem. If a Bank of America failed, you had so many issues in the financial market. If a bank in small town USA failed,
it's just going to be relegated to that community.
Yeah, it was almost like too big to fail and too small to care.
Oh.
And that's, to me, somebody that has been in community banks and involved in that space for so long, that's a problem. You've got the government and the making sure these large institutions are saved, but they're not saving the smaller ones. So, and I understand. I mean, those large institutions, it is a systemic risk to the financial markets if they fail. But if you've got coverage of the government that you're always going to bail you out because you're too big to fail, is that bank taking more risk? They know they're not going to fail. Are they taking more risk? And I think it's an ongoing issue for the industry that has to be addressed. And there was a lot of regulations that came out after the recession, and some of those have been peeled back since then. But some
really,
of those,
like which ones?
It hasn't been major. There was just a lot of consumer protection stuff, which was totally fine. Some of those regulations did require larger institutions to do some stress testing, different things like that. Those are still...
And stress testing is when you go through the loan portfolio as though something has just happened and you say, these 10 businesses, they suddenly start failing. The land appraisal goes way down. Same thing.
Yeah.
How did the bank survive?
Well, for a community bank, it's more or less like that. For a larger institution, they're really stressing the big picture.
Okay.
So they're doing a much more rigorous stress test of, okay, well, what does this bank look like under different scenarios? So it's much broader. It's much more complex. So that was required for large institutions to do as part of some of this regulation. But they still really never address the fact that there's these institutions that are really too big to fail. So it's still out there. There's actually a merger that's happening now between a bank, SunTrust Bank in Atlanta, Georgia, and BB&T, which I think is in North Carolina. That bank, when they're combined, it becomes another one that's likely too big to fail. So it really hasn't addressed, what they're doing. And I don't want to say they haven't done anything. Certainly they've done some things to try to make that not an issue anymore. But I still think it's really lopsided, with that issue. So I'm interested, though. You came into the banking world with no banking experience as far as being involved in one. Were you surprised at the level of regulation that was there?
Yeah, I am. And I think that, so, our close friend, associate Travis Liebig and I, we've been very good friends for a long time. So I've been with him along the way as he was moving up to becoming president of a bank, and we would talk a lot about regulation and how it worked. But it wasn't until I got on the board that I realized, there are the parameters under which you can operate are so restrictive that in some ways you kind of look at other banks and say like, well, how are we different? Is it that we're changing our marketing strategy that's different? I mean, you can offer a little bit different on rates. Like, how do you differentiate it? And that was really like quite surprising for me, because you look at from the outside, you look at a bank and you think, well, they have all the money, they have all the power. But you have to clear so much through the regulatory bodies that it was really surprising. And going back to your point about these larger and larger conglomerations, this is really similar to what has gone on in biotech. And what I have seen is people want more protection. They say GMOs are dangerous. We don't really know if they're safe or not. I disagree with that, but that's what the public perception is. So people add on more regulations. Then what ends up happening is only the biggest people can afford to pay to get through all the regulations. So for example, in biotech, they would say, let's say it takes 4 years of regulatory trials to determine whether or not that genetically engineered crop is going to be safe. Well, the politician says, you know what, I'm not going to require 4, I'm going to require 12 years of regulation. And if each one of those years of regulatory trials is $10 million, you've just stacked $8 million more dollars. If it's 10 million, you just stacked $80 million more dollars of regulatory cost onto that, which means there's only this many companies that can afford to do that. So you just keep forcing mergers to happen. And I'm watching that go on with banking. It appears as though after 2008, just let's keep putting regulations on, which means the little guys can't keep up with the regulatory costs. And so you have mergers of equals, and they just keep coming together. And then you end up having just a few very, very large banks.
Yeah. And that's totally the same. You know, it's kind of the same phenomenon in banking as you described in the biotech world. You know, you've got those systemic large institutions or large companies that get protected, and then smaller ones don't. And, you know, for me, coming from a community bank space, like, that's a disconnect. You know, if I go back to my hometown, which is Central Missouri, Lynn, Missouri, there's only 2 community banks there. Bank of America is not going to go there. Wells Fargo is not going to go there. So how do those small towns get services, you know? And
then you have farm credit systems in there, but those are only for the farmers. So then you have the people that are living in the town that are trying to do grocery stores and little shops, and they don't have banking. Yeah.
And I think it's super important, you know, for those small communities, but it's just as important for a town like St. Louis, you know, to have those community banks that, you know, where the decisions are made locally, and, you know, the board is local and they know what's happening in the town.
You know, that actually, so, you know, when Travis and I were first talking about, you know, a community bank or when he was bringing together the investors to get the bank, he would talk about like the value of community banking. And I would be like, well, what does that really mean? He would be like, well, local decisions. And I thought, who cares, right? Like you're just going to take, you know, people that are locally good versus people that are nationally good. But it completely changes how you understand when a loan comes in. How strong is this construction company? How new are they? Where are they building? Because you have people that literally are in those areas. Yeah. And so if you make it so only the national banks can do it, you're creating giant DMVs in a way. I don't know. I mean, I don't want to be too disparaging because I'm sure there's benefits that I don't understand.
For sure. You know, and I think there's a place for all of them, but you know, there's some of this stuff that is kind of lopsided, but
you know, so speaking of that lopsided point of view, my very first guest on the podcast is a man named Tim Hausler, and he, during the interview, had an idea that he said he put forward to the Fed, and they looked at him a little sideways. I don't know if you heard the interview.
Saw that.
So his idea was, if you want to stop too big to fail, you have FDIC insurance. So what that is, for anybody that's not aware, is every single time you go in and open a savings account, or is it just savings or checking as well?
It's checking as well.
So up to $250,000, if the bank fails, the government will guarantee that money. And and you can open up as many of those $250,000 checking accounts as you want, more or less, right?
Yeah.
And so he said, well, how about instead of saying we're going to limit that, we want people to have those protections. How about any one bank can only be FDIC insured up to $500 million, $500 million. Mm-hmm. What do you think?
I think that's a way to get to what has been discussed, which is breaking these banks up into smaller chunks, and so that's a means to an end, and it certainly may be a great means to an end, because I think the goal was, and a lot of the conversation was, how do we break these banks up to where it's not this massive systemic issue if one of them has a problem, one or several of them have a problem. So that might be a great way to facilitate that. There's other people.
You seem to have a hesitation on this. You don't seem to be fully behind it. So what would you say is your?
I think that might work. I think at the end of the day, they want to break them up, or maybe there's.
Do you think they do? You think they really do want to break them up?
No, I don't think they do.
Okay.
I think it's like Main Street versus Wall Street kind of stuff. There's probably some people that do, but not everybody thinks that's the best way to go. So maybe it's you require additional capital or reserves or something like that for those large institutions that have that protection. There's a lot of different views on how you get there, but the problem is, I don't think, is it really has never been addressed. We're still creating those too big to fail banks. And although there are more requirements, I think the risk is still there to some degree, that they could have that. But like I said, I think his idea is interesting. I think some of this stuff is just going to be really hard just because of how, the political environment, the regulatory environment, and all that other kind of stuff. But I think as bankers, you've got to be aware of some of these things. It's really easy to get caught up in your day-to-day and worry about just your bank and what it's doing. But there's a much broader issues out there for the industry as a whole that everybody should be paying attention to. So,
well, this is actually what prompted me to say that, or to invite you on the podcast, is that, and I don't think I'm talking out of school here. We'll edit it out if I am. But during our board meetings, you come in and give updates, and you actually write a newsletter essentially for the board packet. Well, it's an update. It's like, I don't know, maybe 20 pages long, talking about the economy and like how is the St. Louis region doing? How's that mapped nationally? And I've been making the case that we should turn this into a newsletter and mail it out.
I don't know about that.
But so that is an interesting component of banking that I also didn't understand, because every business has to worry about what are national trends and what's going on in the region. But banking is like very much that way. It feels like you're trying to play baseball because you've got all these via statistics or something like Moneyball, because you are really trying to look at numbers to say what is going to happen and how should we position ourselves. Because if we wait too long and we are too risk averse, then we don't make any money and the other banks do, and then they can grow and push us out of the market. Or on the other hand, if we get too much risk and we make too many bad loans, then we lose our capital and we're out of the game.
Correct.
So what are the numbers that right now you think, hey, people should be paying attention to these things?
So here's the problem with some of that stuff is it's data overload. There is,
yeah, no doubt.
There is so many statistics, so many opinions, so many indicators out there that it can be overwhelming for anyone in any industry. I think. What we've tried to do is zero in on, a group of ratios or a group of economic indicators that we pay attention to. Otherwise, it's just too much. So the things that we include on an ongoing basis, or at least monitor, are things like unemployment trends. What's happening nationally with unemployment, what's happening in the St. Louis market, and
right now that number is like people can't even find good employees, that there's like real pressure that means wages go up, and
Yeah,
So that looks like a
exactly.
pretty good number,
Yeah,
right?
exactly. And that's why it's like you kind of have to look at several of them because it's they might give you different signals, but it may come down to an awareness issue that you just have to be aware of what's happening in that market because it can affect your bank, your borrowers, all that kind of stuff. But some of the other things that we look at are consumer confidence levels. Are they trending downward? Are they going up? We look at housing market indexes. So it's kind of a confidence index for the housing, the builders and the people building homes throughout the country. We look at purchase managers index.
What is that?
It is basically a more manufacturing type of index, and it's not the CEO that you go to and say, "Hey, how's your business?" and he or she goes, "Oh, it's doing great." You're going to the person that buys the inventory to make the widgets, or that is making sure that they've got the things to produce their market and go, okay, well, how are you feeling? And if the purchasing manager is like, we're slowing down, I'm going to back off, that index will reflect that.
And who is going to make those calls? Who's calling up the purchasing person?
A lot of it is just like industry people, so like the housing stuff is through a national association of home builders kind of thing. The purchasing managers are through like an institute for manufacturers. So it's all national kind of legitimate industries or organizations that monitor this. But like I said, if all the purchasing managers that this organization surveys says, I can feel it, our business is down, our orders have trended down 3 months in a row, I'm here, or my confidence is here. That should tell us as a bank, okay, well, do we want to look at our manufacturers? Do we want to reach out to those borrowers and say, hey, how's everything going for real? Yeah, and get ahead of some of their issues.
And why would they tell you if they have problems?
They should.
But why?
Because if it's your banker is not your enemy. They need to let their banker know if they have issues, and because the banker might help. They may come to the bank later and ask for, okay, well, can we have a little relief on the payment? Don't wait until things are bad to let your banker know that, because the last thing anybody wants is a surprise, and that's why it's important to bankers to keep in touch with their borrowers and make sure that they know it. And a borrower that's not being full disclosure with a bank, it's not a relationship that as a banker you want. You want that trust. You want that, I won't say a partnership because that implies something different, but as a borrower, you want a banker that understands your business, that's going to be there for you, through thick and thin, because it might be tough, if you've got a bank that's going to come down really hard and not work with you, you're going to have a harder time.
So what does that mean? So if a banker is there for you during the hard times, so to somebody that isn't taking out lines of credit,
Yeah.
what does that mean?
It's maybe working with them to restructure their debt or to give them a little bit of relief when maybe they've got seasonality in their business. Their business dries up during the summer months or something like that. And it's just really working with that borrower rather than saying, okay, your numbers are down, get out of here. And some banks, some borrowers at that point in time, they can't go anywhere, and sometimes that happens, to where you just, you just can't work with them anymore, and you both go to your own separate corners, and that's not the scenario you necessarily want, but you do want a bank if you are having a hard time that will take the time to understand what your issues are and maybe work with you to see if it can be resolved. If it's just a kind of a rough patch you're going through, I think you want a banker that'll help you through that, and hopefully you come out and everybody's fine. But
so as the person that's head of credit, you have a high pressure situation in that. I mean, your bank listens to you, right? And there are people that could be in a hard spot and you actually have to make the decision, are they going to get out of this hard spot? Because if they don't, and I give them more leash, then the people that trusted me with their money are not going to be repaid. And it's not like everybody that's involved in a bank can afford to lose that money.
Correct.
And so how do you manage the stress of that? Is it something you think of as stressful?
For sure. It's just kind of the nature of the beast, you know, from a standpoint of lending in general. You know, you've got everybody always says, you know, I've never made a bad loan. You know, you never make the bad loans. They just kind of happen for you. But it is going to happen. It's a risk game, you know, and what you want is enough mitigation or enough to where you can get ahead of it. And you're not always going to be right, and you can't sit there and you know, dwell on that, but you kind of have to be right most of the time, or you have to know how to maneuver stuff. So
at what point did you start realizing I actually have the real power here? And I don't mean that in like a, you know, hoisting a sword above your head or something like that, but I mean like the power to change people's lives.
You know, I think you go through as a whatever worker, you know, in any industry, you go through different jobs and you find out what you're really good at, you know, whether it's on the sales side, whether it's on, you know, a more audit level side or detail side. And I think for me, you know, that's where I gravitated to was, because I tend to think things through, maybe overthink from time to time.
Yeah. For example, when I asked you to do this, you were like, sure, we'll do it in like a few weeks so I can think about what I was going to say. And I was like, no, you agreed we're doing it this week.
Yeah, I would have much rather overthought it. But I you know, it's definitely one of those, probably the one time that I remember that I was like, whoa, you know, this did make a difference, was at my first job. And I was new to kind of a credit officer role. And I was at the banker's bank, and we were working with another bank. So our customers there were other bankers, you know, that were way more experienced than I was. And I was probably late 20s at the time. And they had approached us about doing a particular deal, and I just couldn't get there. You know, the numbers didn't work for me. I didn't feel good about the deal. And it was like, okay, I'm going to tell this banker with way more experience that I can't get comfortable with their deal. And that banker, we ended up saying, you know, we can't help you with it. And he was like, totally get it. He sent me a note. It was probably 5-6 months later. And he was like, thanks for the no. Because it ended up that they didn't do the deal, and it was a deal that they shouldn't have done. You know, so and that's why I kind of ended up with saying no to a borrower is not always a bad thing. You know, it's really us taking a look at it and going, you know, this may be too much leverage for you. And some borrowers appreciate that, and others, you know, take it personal. And it's really not that. You know, we just look at it from the standpoint of, you know, what things are, you know, we think are going to work, and you know, decide there. So
one of the things that sticks out to me about you, in fact, some of the very first times we met, was your willingness to say no, right? And I've talked several times with various people on the podcast about this trait called agreeableness, right? And so this is, you know, how likely are you to decide that I would rather the group get along, and I don't really care if we get to the correct answer, versus I need to resolve this conflict and I don't care how much disturbance it makes. Are you, I mean, where do you fall on that scale? 100 being the most agreeable, 0 being completely disagreeable.
You know, I would hope I'm kind of in the middle. But you've got to have an opinion. You know, I don't, and my opinion might be totally different than another person's, but I would never encourage an underwriter not to say anything. And I've talked to people that have worked with me over the years, and if I charge them with underwriting a deal, and if they don't like it, raise your hand. Don't sit there and take orders from somebody and just, not think through it. Have an opinion, voice it. I think there's, you can do it in a way that certainly is better received than other times. But I think, inherently from a banking perspective, there's always that push and pull from the sales side and the credit side. And I think I've always worked in institutions that valued that separation, that valued that push and pull from the standpoint of, you want to make the deal, but you've got to have that control. So if I was, like I said, I've been fortunate to be in institutions that understood that balance. If it gets out of balance and it's more about sales than it is about credit, that's when your decision, maybe is going to be just do the deal.
Do you think people can learn to be more disagreeable or to raise their hand like that? Or is it something you either got it or you don't?
I think they can either be encouraged to do it or not. Some people maybe never get comfortable with it. Those aren't the underwriters that I want.
Okay.
Yeah. And but if there's been times where, I've got to say, hey, it's okay. Like if you don't like something, I want you to raise your hand. I want you to say something.
So are you disagreeable in other parts of your life? I mean, would your family say no?
I don't think so, but
would your family? If they were listening to this, they would say, "No, Rita, she's always bringing up the problems and making sure we confront it." And
I think most people would just say that I've got an opinion on stuff, and I'm not afraid to voice it. And if it's something that is that I feel needs to be brought forward, that's part of my job. I'm not going to apologize for it. And so, and like I said, that's from an underwriter standpoint. I want underwriters that bring to the forefront issues and not just sit there and do their job and not ask questions. And I think, you've got to be in an environment that appreciates that encourages it, or else you do end up with people that are afraid to speak up, or afraid to say anything. And there's a lot of differences in an organization from a diversity standpoint that becomes pretty important to me personally. So, yeah.
Would you say that people feel like they can disagree with you?
I would think so.
I mean, the reason I ask, so I had a chemist on named Dr. Doug Salmons, and he's one of the most disagreeable people on the face of the earth. Like, no joke. He's a chemist that has discovered all sorts of interesting things. And it took him the better part of 4 or 5 decades to figure out that the reason that people didn't disagree with him was because he was so disagreeable that he didn't know. And I just think, like, you are an extraordinarily confident person, or at least that's the way that it comes off. And so I'm just curious, because I think you're in an interesting dichotomy, right? You are saying, I want people to disagree more. Mm-hmm. I believe they can be taught that. You are already pretty disagreeable, so it would be hard to cultivate that. I don't know. I'm just thinking here.
Yeah, I just would be real hesitant on kind of a group think kind of thing. It's okay for people to disagree. It's totally okay. If I don't like a deal, I'm not gonna. If we're voting on making a loan. If I can't get comfortable, I'm not going to vote on it just because the 5 other people at the table says it's a good deal. As
a member of the board of directors, I can say that is awesome.
The deal might still get done, but I don't want to vote just because everybody else says yes. There may be times where you talk through a deal and maybe somebody brings up a point that says, well, what about this? I can be swayed for sure.
Oh, really?
For
Okay.
sure.
That's probably the key thing, right? If you're super disagreeable, but that's because you're already convinced you're right, then no one will.
Yeah, I think you just have to listen. And I might go into some of the meetings with, okay, I'm not comfortable with this, or I want this. And then, you talk through it, and I will get to the point where it was like, okay, I can get there on this deal. So, and I think it just takes open communication and respect for all the people at the table and all their opinions to get to that point. But I don't have, a real issue with somebody disagreeing with something. Everybody should have their opinion. And like I said, as an underwriter, I'd rather have an underwriter voice it than keep it inside and never say anything about it.
You were asking earlier about me being surprised about regulation. I would say the bigger surprise that I have is how much of banking is relationships. Mm-hmm. And you have this really interesting kind of tension, a dichotomy there of you want to be able to have people that can account for, I know this person, they're just going through a rough time, they're just this is their situation, they've got a lot of potential, versus these are cold hard fact numbers. Mm-hmm. And bringing together inside of a bank the people that can balance those two forces is really, really difficult.
Yeah, but it's essential in working, in being successful, because it all really does come down to relationships amongst people at the bank or any business. Your relationships with the customers, and then your relationships internally. So it's definitely not a transactional kind of business.
Do you do anything to keep yourself objective there? I mean, I would imagine that that in your role, you go to enough client mixers and meet enough clients, that would start changing your opinion.
It can. And sometimes it's helpful. Sometimes meeting that borrower, for me, it makes more sense. But definitely, I don't want to make a loan because, oh man, I met them and I really liked them. It still has to support. The numbers have to be there. And I think when you're in that sales role, you definitely have more of a personal relationship. I don't think in my role that I do have to separate that and really look at it at more kind of factual basis. But, it is a balance. And, if we all had a crystal ball, it'd be fantastic, but you don't, everybody always says, like, whenever you get in a situation where you're sitting there going, okay, should I really make this loan? And I've done this. It's like, okay, if it was my own money, would I make this loan? And sometimes when you ask people that,
Does it always make them more conservative?
A lot of times.
Yeah.
Yeah, because it's like I'm loaning the bank's money out. I'm not loaning.
It's not going to come out of your paycheck.
Exactly. But it's like, it's a question that you have to ask yourself, would I give this borrower money? And if I sit there and go, no, then my vote at the table needs to be no, or I need to, make sure that deal doesn't happen.
In that regard, how do you incentivize a credit officer? Because your job is not, it's not have that pipeline be as big and full as possible. So how do you, how are you incentivized, or how are other people incentivized to do right by the bank?
So if you're going to measure a credit officer, it comes down to some asset quality metrics within your portfolio. Maybe it's a past dues level. Loans, every bank has rating systems, to where you rate the risk of your loan portfolio. And the regulators use a rating system as well. So they'll come in, whenever they come in for their exam, and they'll rate your loans. And so if you get too many rated in the bad categories, you're in trouble. And I think as a credit officer, I should be held accountable to those types of metrics. If I'm making decisions and those metrics are indicating that our portfolio quality is getting worse and worse and worse, we got to figure out what's going on.
Wow.
Anyway, so I'm not measured on how much business I bring in because it's none. But there's still accountability that I've got to make sure that the loan portfolio is graded properly, that we're recognizing the risk in it, and that we're addressing it. And so there's a lot of ways to do that, but it's primarily through, kind of credit quality metrics.
So let's make it real for the listeners in terms of if they were starting a new business, we'll just imagine that they've figured out how to make a new hot sauce and it's really good and they want some money to be able to take it from their kitchen production to factory style. What are you looking for as a credit officer to determine, yeah, this is a good choice. We should make this decision.
So there's a lot of things that a borrower would want to do, get the financials in order.
And what does that mean?
Just make sure that if it's a startup, that they've got, their personal financial statement accurate, encompassing all their assets, that they filed all their tax returns and those are all up to date, that they've got a business plan where it can evidence to a banker that they understand their business, they understand the risk, they understand how to produce that hot sauce from ingredients to the day that it goes on the shelves for sale. So a lot of thought needs to be put into that, and that's what a banker will expect. I think it's helpful, and I've had conversations with different people that knew I was in banking and had their own business, friends of mine that, they would ask me different things about, well, how does it work on your side? And I think that's important to understand from the standpoint of a borrower, what are we really looking at? And, they call it like the 5 C's of credit. And it comes down to character, capacity.
What does that mean, capacity?
That's basically their ability to make the loan payments, and the capacity for them to carry the debt.
Okay.
The other ones are capital, collateral, and conditions, which is kind of what the industry is doing. And so, you can debate, maybe there's a couple other C's out there, but even if you go to an institution that does like artificial intelligence and does credit scoring and all that kind of stuff, some of those components of those 5 C's will be built into their models. The character part of it is largely measured by a individual's credit score. How they pay their bills. Do they pay on time? Have they applied for a bunch of credit recently? Are they maxed out on all their credit cards? Do they have a bunch of installment debt out there, in relation to their income? So a lot of the models that are built in large institutions and some small institutions take those factors into account. So there's part of me that, from a credit perspective, is you can have all these tools which are fantastic for the industry, but it does come down to some pretty basic stuff on how you, as a banker, go through your underwriting process and what you measure and what you really spend some time on. And like I said, when I talk to people about, what is the bank going to look at? I end up always coming back to like those 5 C's and what, kind of how we would look at it from an underwriting standpoint.
So let's talk about that first C, the character one.
Yeah.
And this actually is a question. It comes from my brother who is very attuned financially and really despises debt. So pays for everything as much as he can in cash. Well, it's great up until he goes to get a mortgage, right? Because if he hasn't been putting money on credit cards and he doesn't have that score, what do you as a banker say to somebody like him that says, like, I go to get I have a multi-million-dollar business I'm running. I own everything I use. And yet I go to get a mortgage and the banks say, your credit score isn't very good because you don't have any credit. What do you think of that?
I've seen it before. Actually, my mother had the same problem.
Okay.
And, it was funny because she was probably, 80 at the time and had never had credit. And all she wanted was a credit card and could not get one, so it happens. I guess if I would see that, there's other ways that we could do. Okay, well then give me a personal financial statement. Show me your credit or your checking account history. Maybe we would get some statements from how they handled, just their basic day-to-day checking account. So there's other ways to do it. It's very rare, though, that you wouldn't have a credit score, so... and sometimes it doesn't tell the whole story, but it's certainly a basis or a factor that can be used because it is available for everybody, and it it does give an indication of how they pay their bills. So there's ways to get around it. You just kind of have to think through kind of what your options are.
So we've kind of talked on the surface and about how loans get made and the Fed, but one of the things that I don't know very much about because I've only seen it in the abstract is what happens when somebody doesn't pay their loan and can't pay their loan.
If they cannot pay or they won't pay, there's really no choice. From a banker perspective, we have to get our money back, and we will. A lot of times, if that happens, there is an element of, is it a borrower that's going to work with you? Is it a borrower that's trying to get out of it and you want to give them a little bit of leash to him or her a little bit of leash to kind of turn their business around? If it gets to the point where it's like it's never going to happen, or that they're not willing to do that, we've got to kind of assess where we're at. Will our collateral cover the debt outstanding? If it will, then if the borrower is not willing to sell it, then we're going to have to take legal action, foreclose on that collateral.
So you're saying, when you're talking about collateral, you're saying if they have, let's say, like the hot sauce example, if they have a warehouse that they store all that in and they own the warehouse and the land, they've put that up that if they can't pay their loan, then the bank would get possession of that. Correct. And then be able to sell it or...
Yeah.
Okay.
If we had that as collateral. Now, if we just have the hot sauce as collateral, we might be in a little bit of trouble. But it just depends. But that's part of that underwriting process. If I'm going to take on that risk, do I need more collateral to get me over the risk that we're taking on that new venture? Or, do we feel good about this borrower's ability to get outside income or whatever to work out of their issues? So,
have you had to take possession of somebody's property?
For sure. Well, for sure. It definitely. And it's not a good, you don't want to do it, but we still work for a business that's owned by shareholders, and our job is to get our money back. And so definitely, we've foreclosed on, over the years, we've foreclosed on all kinds of property. We've taken back.
What's the most unusual thing you've gotten back or gotten as collateral?
So probably we got back a motorcycle shop. So that one was a little tough because we had motorcycles and then accessories and clothing. So that one was a little bit different.
And kind of a niche market and probably one that you're not an expert in.
Yeah, exactly. So that one was a little tougher. Sometimes you'd get back properties that were in terrible shape, so that presents challenges, because you've got to figure out, okay, who's your buyer for this stuff? We're not in the real estate business. We take it back and then we want to get it out. So, the good thing about banking is, you work with so many different businesses and so many different customers that there's always, all kinds of stuff. It's not always going to be real estate. It may be a piece of equipment. It may be a vehicle. Who knows? It could be, a unique kind of vase or whatever. I've heard of that happening as well. You lend on a collectible item. It's nothing you want to do, but sometimes it happens. We never took back a vase, but it was just different things.
So what is one of the funny things about banking right now is that people don't really go to banks anymore. Correct. I mean, like regular people, their check gets direct deposited. Yep. They very rarely need cash. Maybe you need, $20 throughout the week. What do you see as the future of banking in a world where people don't physically go to banks?
That's a challenge. For banks, they've just got to make sure from a technology standpoint that we can accommodate that borrower and give them the services they need. It still comes down to a lot of times that relationship standpoint, particularly on commercial borrowers, because you're not going to do all that and never talk to your bank, or you shouldn't want to. I have a checking account at the bank that I work with, but my main checking account is still at my hometown bank. I haven't been inside that bank, I bet, in 15 years. But that's my primary checking account.
I mean, it's just such a pain to go through and change that stuff.
Yeah, but it's like they've got the products that, from an online perspective and those kind of things that take care of me. And I think for banks, we're not going to go backwards. People are not going to start coming into banks. It's just making sure that your products and your security levels and all that kind of stuff can facilitate that sort of those banking needs.
One of the interesting effects of having the FDIC saying, hey, if there's the little sticker as you walk in, all the way up to $250,000, then as far as the individual with the checking and savings account, which bank they're at, doesn't matter so much, right?
It doesn't. I mean, and that's what's tough about banking is it's a commodity. Your checking account at XYZ Bank, there's probably a similar checking account at another bank, and I think it comes down to, convenience, who you want to bank with, maybe relationships, those kind of things. So it's tough as a banker to sometimes differentiate yourself from all the other banks out there.
But you did differentiate earlier. You were saying there is a difference between big banks and community banks. And what would you say that is?
I think it's, and that's where you've got to make sure your story gets out. I think that from a community bank standpoint, it is about, you're there in the community, your board's in the community, decisions are made locally. And it really is about a bank helping a community and helping small businesses, large businesses thrive in that market and understanding that market. And I think, I don't want to disparage large institutions.
Go ahead.
There's, maybe I will. But there's a lot of stuff that they do equally as well. But from my standpoint, I want a bank with a bank in my community. And if you look at the St. Louis market, and you've probably heard Travis say this many times, there's over the years, there's been a lot of locally owned banks that have been acquired. And there's a lot of great banks in St. Louis, but over the years, a lot of that has left St. Louis. So it's like, I want to see local institutions thrive because I think it's great for that community. It's great for the industry as a whole that everybody's doing okay. But maybe it's the underdog, root for the little guy kind of thing. But I still want to see that local community bank do great things in their community and really, really get out. And for a borrower, all the decision makers are right there. They're not going to another state or another country, that owns that bank that is, making their decisions from a strategic standpoint. The strategic decisions for our community bank are made in that community, for sure.
Well, that was, I had a dairy farmer on, and we talked a little bit about this. I spent the better part of my late teens, 20s, all the way up until my 30s thinking, I want to go change the world. And the way that I do that is I go as far away from wherever I am right now because the world is out there. And the thing that woke me up was Travis actually showing me, hey, if you have the ability to gather up people's money within a community and then responsibly distribute that out to various businesses, you get to play a major role in seeing whether or not that community can thrive. And it was really like he was offering me a chance to make a way bigger difference than I was going to make digging wells in Africa or playing some political game at the World Bank, which is not really a bank. I mean, it is, but we won't go into that. But that's so when we talk about the difference between the large bank and the small bank, they're just a business. I don't have any ill will towards Bank of America or Wells Fargo, but they are playing a very different game. One is, I'm going to go harvest a commodity in this community. If I can extract money, I will. And if I can't, I won't, which is the same thing that a community bank is doing, except for literally every single person there lives in that community.
Correct. And, I don't want to bash large
We'll just make that assumption. Yeah. Rita does not want to bash the large banks.
But it's true. And like I said, I have an affinity for community banks and what they do locally and what kind of impact they can make on people's lives because I've seen it so many times, and
like what?
Just if I go back to my hometown, those people that want to buy homes, that want to have a business in that small town are not going, they don't have many options. They're not going to go to Bank of America. They're not, and Bank of America doesn't want them. So they've been able to be served by a community bank where they see the people every day out and about in their community. They probably know the kids, they know the parents and that kind of stuff. And it does, it impacts people's lives and it makes them, it gives them businesses that thrive and homes to live in and those kind of things.
I was in a meeting one time where somebody pointed out that the automation that's going on in banking has an impact that is somewhat unexpected in that it used to be that the way you brought up a banker was they started out handing out cash at the teller and then they moved their way up. But the more automation you have, you start with all those easier jobs and then you just keep moving up the executive ladder and automate as much as possible. Yeah. Do you think that's true?
Yeah. It's definitely changed over the years. And if you're a banker that doesn't embrace automation, efficiencies, technology, it's going to become more and more difficult.
What do you mean by embrace? How can somebody embrace that automation?
Not fight it. It's just the way the business is heading. If you can't keep pace at the level of every other bank if you've got inefficient processes, if you've got systems that are so dated because there's banks out there that are way far ahead of you. And sometimes for a borrower or for a customer, it comes down to speed. How fast can I get this? And if
so what's automated, like the collection of the credit reports, or
it could be anything. I think there's banks out there. You look to automate. You look for efficiencies in anything. Is there a way to make that a little bit more efficient? Is there a way to credit score people or to automate some of your underwriting to where you can get decisions to customers really quick? So it's those kind of things that I think every bank, they've got to determine where they're going with it, and if it's a kind of a short-term goal for them or long-term where they go. But certainly, the technology from the standpoint of even as a bank customer has changed. The amount of the times that I write a personal check is nothing compared to where it was.
And that was always the reason that they gave us that we had to learn cursive, was that we had to we wouldn't be able to write a check if you couldn't write cursive, which one wasn't true because you can write one in print, and second of all, like that's all gone to the side. So if somebody is thinking about different careers, do you learn banking in college? What do you think is the right path to be a great banker?
Certainly a business background helps. From the standpoint of there's a lot of accounting, there's a lot of financials and that kind of stuff, whether you're on the lending side or some of the other depository side. But I would say anymore, banks, from a technology standpoint and different areas, there's a lot more diverse opportunities for people. What I would say is particularly on the lending side, you do get exposed to a lot of different businesses and a lot of different things. So, if somebody wants kind of a routine, this is what I do all the time. Probably there's some positions in banks that really won't accommodate that. But,
really, I didn't expect you to say that.
Really? There's some jobs that maybe are a little bit more structured, but certainly on the lending side, it's not, because you don't know whether you're going to have a manufacturer come in and ask you for a loan, a home builder come in and ask you for a loan, or some business that you never even knew was out there. So it's a lot about learning how businesses operate and, learning how borrowers make money, that's essential, at least on the lending side, so.
So could somebody leave their current job being, head of accounts receivable at a plastics factory and then jump over to banking?
Sure. There's always a learning curve. But if they've got an interest, they probably couldn't come over at certain levels. There's always that learning curve of just how the bank works and how to underwrite and how to talk to customers and those kind of things. But there's a lot of different backgrounds that I think could help. But certainly if you've got a business background or an accounting background, it's a great business. So,
and if you were giving advice to a young person in college about getting into banking regarding how they use social media, what do you think? What do you think of the social media and banking?
I would just tell them to be careful, just like with anything, from the standpoint of just don't post anything out there that you don't want everybody to read. So. No different advice from there that I think you wouldn't have in any other industry. I do think it's important for young people to maybe get a couple mentors that can help them. Who
are your mentors?
There's been different ones over the years. Some of them have been bosses that I've worked with, and there was a guy by the name of Bill Donius, who I think you've met, Bill. Mm-hmm. And he was president of Pulaski. And he probably didn't know he was as much of a mentor to me as what he was. Not only did he know banking, but he had a style about him and a rapport with people that you were just like, wow, and it's that kind of stuff that, you want to pick up from people that you're exposed to, like, how did you handle that? At the time I was coming up in banking, it wasn't something that was really talked about. I think it would have been great to have somebody that you can go to and go, okay, well, how did you get here? It would have helped tremendously. So I would encourage, anybody thinking about getting into really any industry, and definitely banking, to, reach out to somebody that's in the industry and talk to them about it. What did they do to get to where they are, and what tools did they use? What training did they do? That kind of stuff. So I think it is important for any young person to have that relationship with somebody that they can go to and just ask for advice. And maybe it's their parents, maybe it's somebody within the industry. But I think, having somebody to talk through those things would be helpful.
So if people wanted to get a hold of you, where would they find you?
I am at St. Louis Bank. Our office is in Town and Country, Missouri, and again,
which is just outside of St. Louis. For people that don't know, it's like the suburb of St. Louis.
Right on Highway 40, so 40, I think. So anyway, it's a small community bank. I'm there every day, and if you want to apply for a loan, Vance, or a deposit account, you just let me know. You can reach me. I'm on LinkedIn. My email address is
I'll put it in the show notes.
Yes.
Okay.
So definitely, we definitely like to help anybody that is looking to expand their business. So
well, great. Thank you so much for stopping by. I know you were very nervous about this, but you did excellent, and I appreciate you being so open. So thank you very much.
Thank you.
Well, that's it for this week's interview with Rita Kuster of St. Louis Bank. If you enjoyed this, I hope you will hit the subscribe button or consider giving us a review. Those 5-star reviews have really opened up the number of people that are finding us on places like iTunes. The other way that people encounter this podcast is on social media, and one place that I am often in is Twitter. There's 2 people I wanted to mention this week that are particularly interesting and caught my eye. I've been speaking with both of them for several years. The first one is a man named Carl Lippert. Carl is an ag tech kind of wonky guy, and he's always got his finger on the pulse of what's new, and he's not afraid to say things that are a little bit countercultural. So he'll be talking about everything from blockchain to smart barns and everything in between. And the thing that I like about Carl is that he sometimes will agree with you and support your point of view, and then sometimes he'll have a counterpoint and he'll want to start a discussion with you. He's always great, and he is Carl Lippert, Lippert, on Twitter. And the other person is a breeder/geneticist from out in California. She and I have known each other because we worked together in the past, but now stay in touch on Twitter. Her name is Kate Crosby. And Kate and I have developed a friendship, and it's gone much deeper over the last few months because each week I send her photos of these small tomato seeds that I've been growing all the way up into being tomatoes. Kate has a very interesting perspective and has just moved into a new job where I think she's been using Twitter quite a bit more. So if you'd like to find somebody that knows a lot, and I mean a lot, about breeding plants and interesting facts on genetics, then I recommend you talk with Kate Crosby. She can be found, and this is kind of an unusual Twitter feed, at _Kate, Kate, _Crosby, CROSBY, So I'll leave that in the description, and I hope you'll go check them out. They are people that are fun and interesting, and it's a good way to get into an entirely new network on Twitter. I hope you'll come back next week because we're going to have a fantastic interview. I sat down with Tony Sansone III, who started a cannabis company out in Las Vegas and was able to sell it just last year for $22 million. We get into the cannabis industry, what he thinks are jobs on the horizon, and even what he thinks will be the impacts on the country as we move more and more towards federal decriminalization. He's a great conversation, and I really hope you will be around for it. So we'll see you next week.